Hello, hello, everybody. Happy Friday. Today is Friday, January 22nd, 2021. I'm Chicago Sean McLaughlin. How are you? Hope you're having a great day. Looking forward to a big weekend. I know I am. Buffalo Bills, AFC Championship. Let's make it happen, boys. Anyway, that's not what you're here for. I'm going to share my screen with you a little bit and show you where we're at. I'm going to actually make some trades here live in this recording for you guys to see. I got some options I'm going to clean up that are expiring today in the next 30 minutes. They're all out of the money. You can see them all up here. My puts on this side, my calls on this side. I'm going to clean all those up. But before I do that, I want to just catch you up on what I've done so far today. Not too active. But the first trade I did this morning, you could see right down here, and I'm kind of doing this first thing every morning, so you can see 1 minute after the market opened, I sold a straddle. Basically, it's really like an iron butterfly. I don't know why they call it jade lizard here, but I sold the at the money strike. At the time, it was 382 when the market opened, so I sold a 382 put and a 382 call. Protected it on either side, $2 away with a long call and a long put. All in, I brought in $1.27 credit, $127. We're only trading one lot here. I also, soon after the open, I did a trade where I rolled my short puts because the market had gapped lower this morning. And so I was holding, right up here, I was holding these 384 puts that at the time were $2 in the money. So I rolled the 384 puts that were expiring today. I rolled them out to January 27th. That's two more series away. That's Wednesday's expiration because that's where I could do it to get a credit. If I rolled it to January 25th and sold the 382 put, which was the at the money put at that time, I would not have gotten a credit for that roll. It would have been a small debit, maybe 5-10 cents. I don't remember, but I always want to be doing credits when I'm doing these rolls. So I rolled it out two expiration series to the Wednesday's expiration series, January 27th, and I brought in a $58 credit. And I had to do it two times because I had two short puts there at that strike. So these are the credits I brought in. And then later on, as the market moved, that 382 that 382 call that expires today that I sold right early, first thing in the morning, about 30 minutes later, the market started moving higher. We got up to about 383. So I rolled that call out to the next series. You can see here on my screen, rolled it out to January 25th to 383. And I brought in a 11 cents credit. Not a big deal, but hey, I want to be bringing in credits. That's the best practice that I want to be in. I'm all about the cash flows. That's my mantra. Cash flow, cash flow. That's my mantra. Positive cash flow, I should say. So those are the trades I've done so far. So what I'm going to need to do now is these options that I'm currently holding in January 22 expiration, that's today, expiring in 30 minutes. I'm just going to close all these down, and then I'm going to have to reestablish some more calls or some more long options in the next week to protect my short options. And I'll show you what those are in just a second. But let's go ahead and close these down. I'm going to put a little spread order in to buy those two. I'm going to sell these two right there in the bid. Those are gone. There we go. I'm going to sell these calls. I'm just getting $1 for them. No big deal. Or I should say 1 penny, but it's $1 for a contract. So I'm closing these all down. Let's work this order a little bit just to get it done. All right, that'll close itself. I'm bidding 2 cents for it. The mid price is 1 penny. I'm sure I'll get filled on this eventually. So now let's go to my Analyze tab. I bring up my curve. And let's hit Analyze, show what my position looks like right now. Let's unselect these options that are going to expire away worthless. And you can see that all I have left remaining here, ignore these working orders here with the big W's next to them. All I've got left now is 2 short puts and 2 short calls. Now, I don't want to be naked short any options heading into the weekend, so I definitely want to buy some calls on the upside, 2 calls on the upside to protect, and 2 puts on the downside to protect. So I don't have any open-ended risk. So what I'm going to do here is go back to the table. So I'm going to go to the next expiration series and I'm going to buy 25 delta calls and puts. Let's see here. I'm going to buy the put here, the 381 strike. That's got about 23 delta. I'm going to buy the calls up here, the 386 strike. Those have about a 22 delta. Now I need 2 of each, so I'm going to buy 2 of this spread. And it's going to cost me 86 cents times 2, about 170 bucks, let's say. It's going to eat into my cash flows on the day, but that's all right. Let's just go ahead and send this order. You can see my working orders here. Still working that order to exit those puts, which I'm sure I'll get filled here shortly. Let's improve our price here 1 penny just to get a fill and get into these calls and puts. Let's improve my price one more time. We'll do 1 more penny. See if we can get filled now. Boy, market's being stubborn. There we go. There we got the fill. All right, now if we bring my curve back up, we'll see. Let's see how this looks. Still got those working orders. Ignore those. But now you can see that I've got puts protected and I've got my calls protected. Now here's the important thing, guys. Actually, no, we're not done. We're going to do 1 more trade because I want to bring up my history. You can see all the trades I've done today. I've only brought in an $84 credit minus commissions and fees, minus about, let's say 13 bucks there. So I've only brought in $71 so far today. I'm just being picky here, but I want to have a minimum of $100 cash flow every day. That's my goal. You can see my positional delta here is negative 32. So to bring in some more credits and to neutralize my delta, I think what I'm going to do is I'm going to sell a put spread that'll give me some positive deltas. So let's do that. And then this will get my cash flows where I want it to be. I'm going to sell the Monday expiration. That's the next expiration. I'll sell the nearest options here. I'm going to buy the at the money's at 383. It's a little almost out of the money now as the market moving up close to 384. The 25 delta is the 381 strike. So there we go. If I were to sell this spread, I'll bring in around 46 cents. So let's go ahead and do that. And then that'll get my cash flows where I want them to be. And there we go. We got filled there at 46 cents. Now if I check my cash flows, perfect. Now I'm at 130 minus, we'll say minus 13 bucks. So $117 net positive cash flow today. That's where I want to be. Perfect. And my positional delta is around a negative 14. That's great. Ideally, I want to be plus or minus 25 when I'm trading 1 less. So that's good. Now let's check out the curve here, and let's do a little analysis real quick to see where my risks are, what my exposure is. So you can see here that, again, well, I wish I could just get these things filled. Let's just pay too much to get rid of them. There we go. Get off my board. All right, so all my options are now closed in today's expiration. So here's where my position now stands. You can see it here. You can see all my short options down here. You can see my long options up here. Okay, so let's focus on the downside for a second. I've got a short put at the 383 strike, and I've got 2 short puts at the 382 strike. So worst case scenario on Monday, if the market crashes and I were to get assigned against my short puts, right? That's the worst case scenario. Well, I could exercise the long 381 puts that I have, and all in, once all those transactions clear, the most that would cost me is 300 bucks. 400 bucks, excuse me, because I got 2 puts at 282, protected $1 away, so that'd be $200 to cover that. And I got 1 put at 383, protected $2 away, so that's 200 bucks. So 200 plus 200 is 400. So worst case scenario, if the market crashes tomorrow, this weekend, and I gotta close these puts, out of pocket, it's going to cost me $400. On the call side, I got a short call at 383 and a short call at 384, protected at 386. Most that would cost me is 500 bucks. So actually, there's more risk on the upside. $500. If the market opens at 400, if SPY opens at 400 on Monday and I get assigned against my short calls, I could exercise my 386 long calls. And at the end of the day, the net cost to me, cash out the door, will cost me approximately 500 bucks. Why is that important? Because if I go back to my trades, my history here, if I show every trade since I started this campaign, let's go back to the beginning of this week because we started it this week. If I look at every trade I've done this campaign, I've brought in $870 minus commissions. Let's just be conservative and say I'm up $820 net cash flow, right? $820 I've brought in. And so worst case scenario, if the market screams higher and I got to pay $500 to cover all my calls, and obviously that means these puts would all expire worthless. If it costs me $500 to cover all those calls, but I've brought in $870, that means I walk away positive $370. So the important thing here is I am now essentially in the money. I'm in a can't lose situation. And that's the whole thing we're trying to do here. That's why we're focusing on cash flows, because over time, this will all work out. That's the theory, guys. And I'm still testing it here, and I'm testing it so you don't have to. So I hope that this is giving you guys some interesting ideas, some things to think about. I'm happy to share with you, warts and all, including my terrible video editing skills. But I hope this is good for you guys. I hope you have a great weekend. Thanks for tuning in. And one last thing. Let's go, Buffalo!